This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Friday, July 24, 2026, and this is the New York pre-market. Now, let's get into it. We are looking at a sectoral split in the American equity market, so wide it creates two entirely different realities by 4:35 Eastern. The Russell 2000 is holding its ground near $292, while the S&P 500 has sliced through $738, dragged down by a 1.23% daily wipeout. But if you look closer at the components, the story isn't just a decline. It's a mass migration. Capital is fleeing consumer discretion and high-growth tech in favor of heavy industry and energy. Let's get straight into the mechanics of this rotation. We're live on the ShadowQuant Equities edition. It is not just a rotation, narrator. It is a structural breakdown in the consumer psyche. We are seeing the consumer discretionary ETF, crater minus 4.61%. That is not a technical correction. That is a panic exit. When you combine that with the minus 3.5% hit to communication services, you have the entire lifestyle economy being liquidated simultaneously. And look at the sentiment proxies. Tesla is sitting at a 0.75 news sentiment score across 8 separate articles. That is deep retail anxiety. The market isn't just adjusting valuations. It is admitting that the consumer can no longer sustain the debt load required to fuel these growth narratives.
In Pulse, you're describing the emotional state, but let's look at the tape structure on the QQQ because the mechanics are screaming louder than the sentiment data. The Nasdaq 100 closed at $691.96, down minus 1.9%, and critically it has violated the July 23 intraday low of $687.79. That low held all week. Once it goes, the path clears to the left. We are now staring directly at the 10-day low of $686.76. This is a breakdown of the short-term momentum structure. The support cluster is thinning out rapidly beneath the tape.
Which brings us to the elephant in the room regarding that breakdown. The VIX is sitting at 16.64, essentially flat. The market is pricing in a smooth adjustment, but the price action tells a different story. You have a minus 4.61% single-sector drawdown in consumer discretionary and a minus 3.5% hit to communications, yet volatility is suppressed. This is a classic divergence. The fear hasn't arrived yet because the options market is still lagging the spot market. Meanwhile, the yield curve spread is compressed at just plus 0.34 pp. A flat curve like that usually precedes equity volatility spikes. The market is currently asleep at the wheel, and the minus 11.8% gap down we saw in CHTR is the alarm clock ringing.
I need to jump in on CHTR because CIPHER sees this as a fundamental leak, not just a technical wick. Charter Communications is down minus 11.8% pre-market, heading into an estimated earnings per share of $9.96. The headline risk here is customer churn and revenue contraction. This isn't a valuation issue, it's a demand issue. When you strip back the layers on consumer discretionary, you see that the weakness isn't in the tech multiples, it's in the actual cash flows of consumer-facing entities. Compare that to the technology sector, the tech sector, which is only down minus 1.1%. The tech giants are largely insulated. The rot is specifically in the subscription models and the discretionary spenders.
So to synthesize, Pulse identifies the consumer sentiment collapse, Grid maps the technical breakdown in QQQ below $690, and CIPHER isolates the fundamental trigger in CHTR. But SPECTER, you argued earlier that the VIX suppression is a risk flag. How does that interact with the broader index levels? Are we seeing a broad-based contagion or a targeted surgical strike?
It's targeted apex, but the collateral damage is spreading. Look at the SPY. It closed at $738.18, down minus 1.23%. It is currently hovering just 0.35% above its own July 23 low of $735.21. Grid mentioned the triple Q break. SPY is walking the razor's edge. If SPY loses $735.21, we open the door to $730. And here is the real risk. The IWM, the Russell 2000, is down only minus 0.58% at $292.09. On the surface, that looks resilient, but I'd argue that resilience is fragile. The small cap index is being propped up by a lack of participation in the sell-off, not by genuine strength. If the liquidity squeeze tightens further, as suggested by that flat yield curve and the 3.41% core PCE reading, that small cap stability could evaporate just as fast as the big caps are falling.
I have to push back on the idea that IWM is stable, SPECTER. Its stability is illusory. Look at the range. The 10-day range for IWM is $290.17 to $298.21. It is currently at $292.09. It is only $2 away from its own 10-day low. It is not resting easy. It is waiting for the floor to give way. And speaking of floors, Grid needs to address the SPY level. We established $735.21 as the critical juncture. Given that consumer discretionary dropped nearly 5%, can SPY realistically defend that level without significant volume absorption?
Volume is the key word, Grid. You don't defend a level like $735.21 when the constituent drivers, like consumer discretionary and communication services, are getting slaughtered. Look at the defensive outliers. Edwards Life Sciences is up plus 6.3% on a Leerink upgrade. The healthcare sector, healthcare, is up plus 1.26%. This is where the smart money is hiding. They aren't trying to buy the dip in consumer discretionary. They are rotating into healthcare and industrials. The industrial sector, industrials, is up plus 1.73%, making new relative highs. The market isn't crashing broadly. It is performing a heart transplant. It is swapping out consumer/discretionary exposure for industrial/hard asset exposure. The question isn't whether SPY holds $735. It's whether SPY becomes irrelevant as a gauge of health because the composition of the index has shifted so drastically.
That is precisely the sentiment shift I've been tracking. The fear metric isn't just about drops anymore. It's about the abandonment of the growth at any cost narrative. Retail investors, represented by that T-Slaw sentiment score of 0.75, are realizing that their beta plays are no longer protected by liquidity tails. They are fleeing. And notice this, even consumer staples, usually the last bastion of safety, is down minus 1.39%. If staples are selling off, it's a liquidity sweep. Everyone is selling everything to raise cash. That makes $735.21 on SPY incredibly difficult to defend without massive intervention or a sudden shift in macro policy.
Let's lock in the three major vectors we have identified. First, the tech/growth liquidation. Triple Q has broken structure below $690, with support now pinned at the 10-day low of $686.76. Second, the consumer collapse. Consumer discretionary is down minus 4.61%, driven by CHTR minus 11.8% miss and broader churn fears, isolating the distress to consumer-facing revenues. Third, the industrial pivot. The industrial sector is rallying plus 1.73%, while consumer staples cracks, signaling a flight to tangible assets and cash flows over speculative duration.
The priority is watching the SPY close relative to $735.21. If we close below that, the technical damage is confirmed, and the algorithmic selling programs will trigger on the way down towards $730. However, if we hold $735.21, we enter a consolidation phase. The triple Q is weaker, yes, but triple Q is driven by earnings growth expectations. Since CIPHER noted that the technology sector is holding up better than consumer discretionary, the tech sector itself isn't collapsing. It's just being punished for its high duration. So the technical risk is concentrated in the SPY and consumer discretionary overlap. Keep an eye on $735.21 as the binary line.
And don't forget the catalyst window. AXP American Express is reporting later or effectively impacting the narrative with an earnings per share ESD of $4.41 and already down minus 4.8%. If AXB follows the CHTR trajectory, admitting consumer weakness, the SPY support at $735.21 becomes theoretical. You cannot have CHTR down minus 11.8% and AXB weakening without dragging consumer discretionary further. The fundamental weight is pulling the technical floor out from under the SPY.
Agreed on the fundamentals, CIPHER. But from a sentiment perspective, the minus 11.8% move in CHTR is the shockwave. If that doesn't bounce sharply in the first hour of Monday open, the fear and greed meter will reset to extreme fear. And when that happens, the bid side disappears. There will be no one left to buy the SPY dip at $735.21 because everyone is waiting for the other shoe to drop. The liquidity dries up when sentiment hits that wall.
And that's the trap. The VIX at 16.64 is lulling traders into thinking there's room to average down. But with the 10-year 2-year spread at plus 0.34 pp and core PCE stuck at 3.41%, the macro environment is hostile to averaging down on growth names. The market is mispricing the risk of a hard stop in liquidity. If the Fed is forced to hold rates at 3.63% due to that sticky inflation, the valuation compression in consumer discretionary and QQQ isn't over. It's just finding its equilibrium.
Final synthesis. The market is undergoing a rigorous stress test. Technically, Grid has highlighted that SPY is testing its 10-day low support at $735.21, with QQQ having already broken below $690. Fundamentally, CIPHER and Pulse agree that the driver is a consumer credit/debt unwind, evidenced by CHTR minus 11.8% collapse and AXB's early weakness, which is draining liquidity from consumer discretionary. SPECTER reminds us that the suppressed VIX at 16.64 masks a dangerous macro setup with a flat yield curve and sticky PCE. The result is a binary regime. Either SPY defends $735.21 on weak volume and consolidates, or the fundamental pressure from consumer dislocation breaks that support, accelerating the flow into the industrial sector and the energy sector. There is no middle ground here. The era of passive beta gains is paused. Active sector rotation is the only play.
A clear picture emerging. Technical support at $735.21 is the hinge for the S&P 500. Fundamental pressure is mounting via consumer and communication services, led by CHTR and AXB. And macro risks are lurking in the flat yield curve and suppressed volatility. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.